All right, good afternoon, everybody. Event trader coming on here. Just we're going to be keeping an eye out on the broader markets as per usual. Certainly been a bit of a choppy session here. Looked like we had a descended triangle going on from my vantage point going into that lunch hour, but it continued to hold it up with that 45.65 area, we'll call it, providing some support. Haven't really been able to find any buyers above 45.75. So again, just leading to a pretty tight, choppy range over the last 3 hours. I've been spending most of my day on that Goldman Sachs Financial Services Conference. I've been providing a lot of different color on it. So you should have a fair idea of what I've been up to, but we are going to open up the options playbook to find out what options trader Brandon Mars is up to with some of his recent trades. Brandon, you continue to hit out some real nice plays there for the group. So thanks very much for that. I know it's very much appreciated by the subscribers, but would be curious to hear what your thoughts are on the market right now. Where's your mindset as we go into the final month of the year?
Yeah, I mean, like you said, just kind of a choppy day. I mean, I think it feels kind of healthy. It's kind of annoying to have these choppy days as traders because I think we're kind of always looking for the action and hitting a nice home run here and there. But I think overall, after the move that we just had, I mean, a couple percent pullback or whatever this has been. I don't know the exact number off the top of my head, but just a little bit of a pullback seems kind of healthy. Maybe, a little bit of profit taking, flush out a few sellers here and there. And, I think as long as we kind of hang around this area and don't break down too much further, I would imagine this would probably be a stepping stone towards a continued year-end rally. And, as long as we don't get any curveballs, I know we've got the jobs report and stuff coming up on Friday. So always some curveballs to contend with out there. But as long as the markets don't break down too much, I think this nice little bull trend will remain intact through the end of the year.
Well, we're definitely on the same page there. So I guess my question for you would be, I know you are always studying the charts. What are a few red flags for you that could, that if they were to occur, you would kind of maybe roll back that outlook?
Yeah, I'm a big fan of watching the 20-day or the mid Bollinger Band, if you will. So on the NQs, looking at it right now, kind of sitting right above it, a little bit of a breakdown below it. So far, we haven't closed below it though, which is good. So if we started breaking down in closing below that, I think anytime you dip below it, it's sometimes potentially just a little bit of a bear trap to draw on some shorts and make people think the market's breaking down. But we haven't really seen that. But if we started to get a couple hundred points below it, then all of a sudden I think the 50-day moving average would come into play. So that's kind of the big line in the sand that I'm watching. And then I look at RSI a lot. RSI is above 50. That's something I always like to see. I like to pay attention on the shorter term to the 5 and 10-day moving average. There's kind of if you look at charts enough, anytime the 5 crosses above the 10 or below the 10, you can usually catch that trend until they then reverse positions again. Seeing a 5-10 cross on the NQs is a little bit of a warning to me that we might see a little bit more pressure. So keeping an eye on that, and again, as long as we don't get too much of a major breakdown in those, I'll probably remain in the bullish camp.
Yeah, no, again, uh, all on the same page there. That XLC, that was the first one to kind of come in and dive down below that 20-day moving average. We are starting to see a little bit of money flowing back into the mega cap names there. I know you trade a lot of the mega cap names, Brandon. So, kind of what's your thoughts going on here on that action? The XLC in particular, with Meta Platforms and Google, two names that I know you trade a lot.
Yeah, so I talked about this a little bit in my morning notes. So a good segue into these names. Yeah, I mean, I think the big tech, it was probably due for a little bit of a breather. Pulling back a few percent here or there after the run they've had this year, I think is probably just, in my opinion, just healthy market behavior. You're gonna have some sellers at some point after a huge run, no matter what a stock does, no matter how parabolic it goes. It always happens. Um, so yeah, I had mentioned Amazon and Microsoft in particular. Again, one candle on a chart isn't an all-out buy or sell signal, but you started to see a nice hammer candle on Amazon, on Microsoft. And again, sometimes those can be a head fake, but it was at least showing some buyers stepping in, and they kind of started to look like some callback, or excuse me, some pullback long candidates to me. So saw a little bit of a bounce there in both of those this morning. I actually had mentioned I really liked Amazon. Just ended up moving almost 5 points in the first, hour or so of trading. So just kind of moved a little too quick for me. Again, I don't do a ton of trading in the first 30, so I just didn't want to chase it after that move. I wish I had.
Especially with that ISM and Jolts number, right?
Yeah, exactly. I mean, it catapulted right off the 146 level right after that. So yeah, that would have been a really nice quick options trade. If you were in, you were out, probably made some pretty good money there in half an hour or so. So yeah, just kind of catching my attention a little bit on the charts, and Amazon in particular. I had mentioned this again in my notes this morning, but it's been coiling around that 147 level. Um, Compared to the other big tech, I mean, it's seen a little bit of a pullback, made a little bit of a dip below that 20-day, but it's held up pretty well. And sometimes when you get that dip down below the 20, again, they create a head fake. Essentially, they're gonna basically make people think that this stock is breaking down, and people are gonna get out. Maybe some shorts jump in, and then they continue it higher. And again, there's no guarantee of that, but I mean, we are kind of seeing that with the bounce today. And those can create some pretty powerful moves to the upside, because you've got some more shorts that are trapped, and then you've got some sellers or more sprinkled in there. And sometimes when the wave of short covering and buyers comes back in, it can create a pretty powerful move. So yeah, just sitting there floating right around that 147 level. I think that's probably, the most intriguing big tech chart to me. And yeah, like you said, the XLC, I mean, definitely a little bit of a hit there. I mean, again, some huge runs.
I mean, let's not forget too. 47% of this is Meta and Google. So, just look at those two charts. Basically, spitting images of the XLC here. Not surprising.
Yeah, absolutely. Yeah, I am starting to think that those are maybe going to become a little bit attractive here for a bounce. I got to imagine that there's probably some fund managers that want to show Meta on their year-end fact sheets after the run that it's had. So keeping an eye on that. I mean, we're not really seeing maybe the greatest bounce, so we gotta maybe be a little careful on those if this is maybe some consolidation before a little bit of a lower move. And I mean, you were asking earlier from a chart perspective. I mean, I don't love the fact that like Google, I mean, it's now below its 50-day, its 20-day, 5-day, 10-day. I mean, it's really only got the 200-day moving average below it. So
I
it's
got
not
it.
such
I
a
got it
much
sitting
date.
on the lower end of its Bollinger Band right here at 128.2.
Yep. Yeah, I'm seeing that as well. So, if that Bollinger Band starts to kind of slope downward, there's always that possibility that you kind of ride the Bollinger Band, which is a very common thing for stocks to do. So, if it doesn't get moving off that 130 level here, I'd say maybe sooner rather than later. I might see a little bit more on downside with this sector, because, like you said, there's such a large weighting to the XLC, and then the other one, Netflix. I mean, that chart's not necessarily looking all that great. Looks like we've kind of got a inverted hammer candle setting up there on the daily chart right now. Still a lot of time to go trading wise today, but that could be a potential sign of a bottom. Again, one candle doesn't mean just go and jump into it, but I think it probably bears watching. And if it did get a little momentum, in theory, you would think it would probably at least go and retest that 20-day area around like 460. So, it could create a nice trade if we get a little bit more momentum back into big tech.
Okay. Would also notice subs highlighting that Google also at the 78% fib number. So we know Fibonacci traders going to be keeping a close eye on that. So these big cap tech names, they're going to make for an interesting move into the end of the year. I'm really curious to see, Brandon, which direction they're going. Can I throw a curveball at you and ask you about another chart?
Please do.
Bitcoin, Brandon. So I know you were in the industry for many moons, and 2018, I'm sure you recall, where everybody and their grandma was putting out company names that had some sort of Bitcoin in it and stuff. And boy, it really feels like it's kind of getting back in that groove to me, where like just everything Bitcoin continues to rip higher. I'd be curious from your perspective. I know you don't trade it. I don't see you getting involved with like the micro strategies or any of the other Bitcoin type names, but just from a chart perspective, as a interested outsider on it, what's your thoughts on Bitcoin here, out of curiosity? And I
Yeah,
ask you because I'm getting an alert on GBTC while we're chatting. So
Yeah, I will tell you briefly one of the reasons why I sometimes stay away from those names. So, Riot Blockchain is a company
yeah.
that we probably know. I don't know if many people fully know this, but Riot Blockchain used to be a biotech company.
Mhm.
Um, I coincidentally had a friend who worked there when it was a biotech company many, many years ago. Um,
Circa 2018.
Geez, I think it was even no, he was actually a biotech worker. So he had worked on the drugs that they were developing way back in the day. And my father and I had actually purchased some of their stock, and it went went nowhere. And my dad held on to his, I dumped mine, and then all of a sudden one day he said, "Hey, I am very much in the green because Riot Blockchain is now apparently biotech to Bitcoin." And he ended up like doubling his money on it, and he moved on. But those things kind of scare me, and you could probably assume why they do. So
Yeah. Good,
um,
good. I was nervous when he started that you might have tried some naked puts or something on it when he started the conversation.
Yeah, that would be like options 101 of how to get burned, basically.
Right.
But anyway, um, yeah, I mean, we had talked about this. I think it was even just last week where I had mentioned that there was a ascending triangle on the daily chart of Bitcoin, and that 40,000 seemed to be in its sights. And geez, where are we now here? Almost 44. So Bitcoin in particular is one of those names that when the momentum gets going, I just don't like shorting it. It just seems like a recipe to get hurt. I know that obviously at some point we're going to hit probably an equilibrium where some buyers are going to say, "Wow, I'm up 10,000 points on this in a couple weeks. I'm getting out of Dodge." Like I said, it always happens at some point. But that chart just looks really strong, maybe a little bit short term extended for me. If we even got another day, and if we got another candle like the last 2 days, we'd actually be looking at a 3 white soldiers, which would, again, show that continued strength. I don't like when charts get way above their upper Bollinger Bands like that. And
Right.
when they get super far away from the moving averages, Bitcoin in particular has a tendency, most assets do this, technically speaking, but Bitcoin has a tendency to run very, very far away from its from its 20-day moving average, both intraday and on the daily chart. And
It's running away from it even on the monthly. I mean, the 20 monthly average is down at 26,000. So obviously, that's a couple of standard deviations above it here, right?
Yeah, I didn't realize it was that far away from it. That would make sense, but yeah, that's pretty far away from it, isn't it? I'll have
Yeah,
to look at that one later on.
especially for monthly. You
Yeah,
have a pretty hefty sample size there, right?
yeah. So I mean, I'm looking at Bitcoin here on the hourly, just real quick, and I mean, just even on the hourly, it is over 1,000 points away, actually like 1,500 points away from quick glance here above its 20-day on the hourly chart. Now, if you look at Bitcoin, when it makes these big spikes, it tends to gravitate back towards the 20-day on the hourly chart, either through price or time or a combination. So when it gets to be 1,000 points away, because I actually do take some Bitcoin trades sometimes at night if I'm sitting home at bored or I'm snowed in or something like
Too
that.
much
So
Pinot.
yeah, too much Pinot. Your words, not mine.
I just know how you roll up there in the fine Pinot land of Oregon, Brandon. So
Yeah, we have some of the finest available, so
you do.
don't hold it against me.
Never, never.
But anytime I see Bitcoin get 1,000 points away from the 20-day moving average on the hourly chart, that has always been a sign to me of maybe don't jump in right away. Not necessarily saying like go and bet against the momentum, although that does create some good trades. But whenever it gets that far away, it just always makes me take a little bit of a pause. And with Bitcoin, it sometimes just keeps going, and that is what it is. But I have looked at that chart a lot, and the 1,000 points above the 20-day on the hourly has just been a very, very common thing that I've seen over and over. And again, I try to stick with the technical rules. So maybe love to see a little bit of a pullback here, but I would imagine you'd probably want to lean towards the long bias.
Yeah, completely agree with that. All right, Brandon. Thank you very much for indulging me on that question. I know some of the subs. I'm sure we're happy to get a little bit of thoughts on Bitcoin here. So why don't we break into some of your trades, Brandon, that you've been putting on as of late? A few names that are on your watch list as well. You only have one trade out there at the moment, and that would be Expedia, EXPE. So why don't you talk a little bit about that, some of the things that you're seeing on why you pulled the trigger on EXPE?
Yeah, Expedia. This is a name I haven't traded in a while. It used to be kind of one of my little hidden ones that, only trades a couple thousand contracts a day that I enjoyed trading, and been off my radar for a while. And I mentioned in my notes, it was yesterday actually. I mean, we saw some pretty nice rotations last week. Again, some money flowing out of the big tech. We saw stocks like Lyft up, I don't know, 13, 14% or whatever it might be last week. And Expedia was one of those names that caught my attention on the daily chart. It had I don't know, 5 or 6 days or so of some sideways consolidation after a nice move up post earnings. Had a real nice, basically ignition candle on Friday, along with the rest of the names that saw some rotation. So I threw it onto my radar yesterday, and then intraday, as I was watching everything on my watch list, saw that it had a ascending triangle that was developing. So jumped on it, and unfortunately, the market just kind of turned a little bit and ended up giving me, unfortunately, a false breakout on the ascending triangle, which again happens technically. Always a little frustrating, but false breakouts occur. And ended up just sticking with the trade because I do like the chart. I do like the breakout of that recent consolidation, and I do kind of like the potential breakout above the 140 level. You got a couple moving averages that are kind of pushing, right below it now, which I always kind of like to see because those can sometimes act as a little bit of a slingshot either to the upside or the downside on the price action. So stuck with the trade and monitoring it. I mean, unfortunately, not my best trade as of recently. So maybe that thank you at the beginning of the call was a little premature on this one in particular. But
They can't all be winners, and you
yeah,
do just fine with most of them. So and again, your risk management, and that's one of the things that we always stress here is certainly top notch. So they're not all going to work out like you said, but uh, yeah, I
yeah,
mean, I wouldn't worry. It's your thinking that is, what's always important, and letting you explain here what your process was going in, I think helps people understand the trades, and I don't think anyone's going to get too upset about one or two losers here or there, as long as the thinking behind it is wise. And I think you kind of rolled that out with Expedia there.
yeah. No, thank you. I wish they were all winners. What an easy game this would be if they were.
Well, if they were, Brandon, something tells me that you wouldn't be talking to me right now. You'd be out out in the vineyard.
I'd
So,
be owning the vineyard at this
y
point. So
exactly, your own vineyard for sure. But, yeah, so let's, break it into you did have a couple too on your watch list, one of them being Amazon, which of course we, talked about in depth just prior. The other one, another, big tech name, Qualcomm.
yeah, Qualcomm caught my attention. If you're looking at the daily chart, call it the mid-November timeframe there, made a move up to the 130 level. Took a little bit of a step back, and then over the last couple of days has started to kind of play around that 130 level again. So as far as some of the tech that maybe took a little bit of a step back, I mean, this one really didn't, and it's just been kind of coiling right around that 130 level. So it seems like a pretty good breakout candidate. I mean, kind of the base is built there. Again, I've been talking about the moving averages today. You kind of get the 5-10 cross. Those are kind of pushing up on the price. Right now, I mean, yeah, again, we've got 2 hours of trading here to go, but the candle right now is a Marubozu candle, which essentially is no wick at the top or bottom of the candle. So again, just showing it opens up at a price, and in theory, the price was just pushed up all day and closed near the highs. So usually a pretty bullish candle to see on the charts. And if we get a close above the 130 level, I would think it would have some room to run to probably the, I don't know, the 132, 133 area. I'd be looking at probably that little peak that we saw kind of at the end of July, beginning of August. So again, if it's outperforming the Nasdaq just a little bit today, I mean, nothing too earth shattering, but still just seeing some relative strength as we're seeing some red out there. And I think this one might be a pretty good candidate, especially if we get some strength back in the Nasdaq.
Okay. We'll keep an eye out on that. Um, so Brandon, let's break into this week's topic, which we got the collar option strategy coming in. There's good reason why you wanted to discuss this week, because could be a nice option for, no pun intended, for people to play in the next coming week. So why don't we break into a little bit of that? And I know um, for people that are trying to follow along at home, Brandon will be going through how the P&L works for this. It's probably going to be very difficult to understand on a real-time basis, but we will have some a nice little um, inclusion on the comment where we will have a link to a way to read the P&L for this particular strategy that should be helpful. So, Brandon, without any further ado, why don't you highlight why you had an interest in discussing the collar option strategy for people to give them a different option for the next couple of weeks?
Yeah, so yeah, again, we've talked. I'm leaning pretty bullish, but I'm sure that there are others out there that might be feeling maybe a little bit nervous about some profit taking as we head into year end. There's probably some portfolios that are sitting on some decent gains here and there after a pretty impressive return in the markets this year. So figured, like you said, we'd just kind of throw this idea out as a potential hedging strategy in case anyone was looking for any sort of portfolio protection into the new year. So collars are typically used, again, when investors want to hedge a long position in an underlying asset, and you really are doing this because you think there's some sort of short-term downside risk. So the basic theory here would be that you are long-term bullish, but you see some of that possible short-term risk. So I guess I probably should have talked about this, 4 days ago or whatever it was before this brief little pullback that we had in the market. But that would basically be a perfect example. We saw the nice run up. You thought that there was maybe going to be, I don't know, a week or two, whatever it might be, of consolidation or some profit taking, and you wanted to provide yourself with some sort of downside protection. So what it involves being long a stock, short an out of the money call option, which is going to have the higher strike, and a long out of the money put option, which is going to have the lower strike. And these would have the same expiration. So essentially what's happening is the long put is acting as a hedge for the stock. So this is where the strategy helps limit your downside losses. And the short call helps finance that long put. Because again, if you're going short the call, that means that you are collecting the premium into your account because you're writing this option. So that might sound a little confusing. And, I think almost any option strategy, when you first hear it, if you haven't been doing it for a long time, usually makes your head scratch a little bit out of the gate. So essentially what you're doing here is you're writing a covered call, which we talked about, I think that was one of our first topics some time ago. But you're writing a covered call, and at the same time, you're just buying a put. So that's really all that this is doing, is just adding one element to really a covered call strategy. And just to keep in mind here, it's similar to a covered call. If your price rises above your short call, that your shares can be called away. So I want to make sure that nobody has any meta shares that they want to go and protect, and then all of a sudden they get called away on this strategy. So again, anytime you're dealing with options and you have both longs and shorts out there, you definitely have to make sure that you're watching where your price goes, come expiration date, so you're not either assigned or you have any shares called away.
Okay, so just taking a look at that then. So give me some examples. You're looking at the meta where you would maybe be looking to implement some of these options, Brandon.
Yes, so I wrote these notes. I usually prepare my notes basically the afternoon that we get off this call. I'm kind of like that. So bear with me here that these prices have changed a little bit, but I was writing these notes last Wednesday, and Meta at the time was trading around 332 spot 20. So basically what you're going to expect on this strategy is you're expecting to have little or zero out of pocket costs as you would choose an equidistant strike price from the current price of the stock that's shown. So again, Meta was trading around that 332 level. At the time, the 335 call was around $1.65, and the 330 put was around $1.70. So in this case, your net cost is just 5 cents per contract. And again, that on a side note, if you own 100 shares, then you can do one contract because, again, one contract is the equivalent of 100 shares of stock. So in this case, it's just a cost of 5 cents per contract. When you're able to cover the entire cost, it is referred to as a zero cost collar. And in certain cases, there is the possibility to create a small net credit too. That would happen if you were writing a call that was a little bit more expensive than the put. Again, I wouldn't expect to get rich if you have any sort of situation where you get a net credit, but it is possible to essentially get this credit or get this protection for either a zero cost or for a small amount of money to be deposited into your account.
Okay, so so basically, again, what you're doing is you're writing a covered call, and at the same time buying a put, right? So, therefore, creating the locks on both sides. Like, so, Brandon, when you're saying you're kind of looking at this as a strategy just to protect some against some downside losses, do you have a formula if you were doing this where like you would kind of have an idea, okay, if meta goes to this is how much I'm going to lose, so I'm going to create this collar option strategy around my expected losses? How would you go about trying to kind of create that in order to hedge yourself?
Yeah, I think that will best come into play actually with that link that we're going to send. I'm looking at the diagram right here in which it would answer exactly what you just asked. It gets a little confusing. Again, it's not a super confusing strategy, but I think it might be easier if we do point some of the people to the diagrams on this particular page we're going to send out, because
Here, give me a quick second. Let me see if I can get it up real quick.
Yeah, and it should be right at the bottom of my
Yeah, give me a quick
notes.
second, everybody. I will get that. So I probably should have been prepared for this.
Usually, these are fairly easy to do over the call, so we won't hold that one against you, Gavin.
Hold on, post it now. All right.
Yeah, and I'd probably just kind of reiterate too. I mean, if you look at the diagram and if you look at this section of the examples, I think when you read them at first, you kind of makes your head hurt a little bit, but just give it a second read. If this is a strategy that you're interested in pursuing, I think it's important to just kind of give it a second read, and I
All
think you'll
right,
start to
that's
realize
up there, Brian.
it's not as bad as it seems at first.
Okay, Brandon, it's up there. So anybody that wants to follow along, again, the link is on the page. Please click on that, and Brandon's going to walk us through that here.
Yeah, so down in the section of, I guess, the caller option, let's see here. In the section of caller option strategy worked example, there's a diagram here. I don't know if you see it on the left. It says payoff, and it says 10, 5, -5, -10.
Yeah. I see it down
Yes.
about 4 or 5 paragraphs.
Yep. So again, it gets a little confusing at first, and what I was going to recommend to anybody again interested in pursuing it is to start at the top there where it says caller option strategy worked example, and to just run through, again, reading it once or twice, at night with your Pinot Noir there, and you just kind of get a sense of a real world example of, essentially how you'd want to construct this thing and what your, potential risk reward would be. So there's a couple of websites out there that have pretty good examples actually on this strategy in particular. This one I thought was the easiest to read. So this is the reason that we shared this one in particular.
Yeah, I got it up on the screen here too, Brandon, for that matter.
Okay, yep, and there's another one that's a little bit lower, same scenario, but it throws in the dollar amounts in there through the real world examples that they put on there. So that's again where I would kind of point anybody that was looking for some additional information on this.
All right, and there you go. There's the chart right there. So yeah, so this will be helpful. I mean, obviously, if anyone's going to have any questions on this, or if you are looking to implement the strategy, by all means, send us in those questions, and we'll point you in the right direction. We can't tell you exactly what to buy or which strike prices, for every option. But if there are any questions, feel free to ask away. Now, we'll take a look at them for sure to help you out on this. As per usual, Brandon, too, I would highly recommend if any of this seems very perplexing or if you're very confused, don't try to figure it out until you could do a little bit of paper trading or something. Brandon, would you agree with that?
Yeah, I would absolutely agree with that. Yeah, again, especially with the fact that you're going to be going short in option. These strategies and the covered call, the reason that you have the other options in place, on both sides of the table, and you have shares in this particular case, those are all protective strategies to basically not get yourself burned as bad as you would if you did any sort of naked sort of call. But I definitely, again, if options is new to you or it's, you don't have a full understanding, I definitely don't ever recommend anyone being short a call or a put in their account until they have a full grasp of the scenario.
Yeah. All right. So just taking a look, what other aspects of this do we need to know about it, Brandon? I know there is ways to make this a zero cost collar or a net credit collar too. What's involved in that?
Yeah, so I mean, for me, there's probably a screener out there. I'm sure that there is. I didn't look actually. You just brought up a good point that I think I overlooked there. I'm sure there's some sort of screeners out there for any sort of options chain that would run the different numbers and you'd be able to construct it that way. For me, just kind of glancing at the option chain, maybe I've just done it too many times that those are burned into my brain at this point, but just sticking to meta. I mean, we'll call it at the 317. It's a little above 317 and a half. We'll just use the 315 and the 320 strike here. You could just kind of pull up that option chain and you can see the current pricing on them as far as constructing and potentially creating a zero cost. I would say that there's probably, and this just isn't my style, so I don't do it. But I'm sure there's some arbitrage situations in there where you get implied volatility that's a little bit more elevated on a stock, where you could, go and seek out those opportunities. Because again, if implied volatility is going up, your premiums are going to be higher, which you would, in theory, collect more on the call that you write, and you'd probably most likely pay a little bit more on the put too, because there's probably something going on. But for me, yeah, it's kind of just looking at the different strike prices and matching up the prices of the options at an equidistant strike.
All right, now there is one thing we need to discuss with this, right? And uh, this might confuse people. So, you laid out the reasons why someone would want to implement this. Now, we started off the conversation here today by talking about our thoughts on the overall markets, and both of us are rather bullish in terms of the final 3 to 4 weeks of trade here. This would not necessarily be the trade that you'd want to have on if you held that same belief, right?
Yeah, so I mean, if you're bullish, you're thinking, Santa Claus rally's on its way, then we're going to go right into the January effect. This strategy isn't for you. So, because essentially what would happen is, similar to a covered call, your returns are going to essentially be dragged down anytime that you put any sort of hedging strategy into place. So, if we've been talking about Meta, if all of a sudden you think Meta is going to recover and it's going to break out to 52-week highs by the end of the year, and you own the stock and you go and put one of these hedging strategies into place, you're essentially not participating in that upside on the stock that you own. Which, like with any hedge, it's frustrating when that happens. I mean, that's why you do hedges. But if all of a sudden Meta moved 30 points over the next couple of weeks and hit a 52-week high as the new year came in, you're probably going to be a little frustrated that you kind of drag down your returns on that. And again, if that happened, just like many other option strategies, you can go ahead and you can adjust, and you could take off the caller position just by closing out your options.
Yeah, we're just keeping an eye too on these headlines. I think Jamie Dimon's prepared remarks might be hitting here. Again, talked about this with Carmine earlier in the week. There is that hearing on Capitol Hill tomorrow around bank capital requirements. I know some people were asking why Goldman's so weak today. I think that could be getting factored in here too. So we'll just continue to monitor that banking sector, see if this disrupts anything. Diamond's talking about how these comments could physically alter the landscape of capital for banks. This has been part of his lexicon. So we'll keep an eye out on these headlines, see if they rattle the markets late on in the day. But all right, Brandon, sorry about that. Just wanted to address them as they were starting to cross. So, like you were saying, Brandon, I mean, well, let me ask you this. Is this something we were talking about? Maybe a little bit of chop coming over the next week or so. I kind of think that we'll chop around until we get into the Fed meeting. So, is this something that you could put on for a Friday expiration?
Yeah, I mean,
Potentially.
you absolutely could. I guess at the end of the day, we'll stick with Meta. Let's say that Meta is going to stick right around this 317 and a half level. If it just moved flat, then the strategy could provide the protection. At the end of the day, you're probably just going to end up writing a couple of options that end up expiring worthless. Which again is not the worst case scenario. But I guess ideally you would maybe want to have a little bit more of a bearish tilt as opposed to chop, just because again, the theory behind this is that it's going to provide you with some sort of short-term pullback protection. But if chop ended up happening, again, the worst case that would end up happening is you'd maybe pay a couple cents here or there for some portfolio protection, and your stock would end up flat and your options would just expire worthless. So again, your overall risk in this particular case would be just what you ended up paying for the strategy. So again, in the example earlier, it was 5 cents per contract. Again, if you ended up finding a scenario where you got a little bit of a net credit, then you'd actually would have protected your stock. It would end flat, and whatever money was deposited into your account, you get to keep at the end of the week. So yeah, it's not the worst strategy by any means. Yeah, again, it's like a hedge. Just you can't really expect to be knocking it out of the park with some of these hedging strategies.
Okay. All right, Brandon. Anything else on the collar option strategy before we let you get going then?
Yeah, I think that we hit all of the points, and yeah, like I said, again, if it is something you're interested in, read through the example once or twice. It's really not as bad as it first seems, and like you were saying earlier, if it is something that is confusing you or you're not quite sure on it, definitely try some paper trading or do some more research before diving in.
Yeah, no, I'd highly recommend anytime you're uncertain to do a little bit of paper trading for sure.
Yes.
Well, Brandon, as per usual, always a pleasure speaking with you. Love getting your perspective on the markets and certainly some of the big cap names that are out there, and always providing some good options out there for different alternatives for people to trade. So, really appreciate you taking the time to meet with us here, and hope you have a great rest of the day there, my friend.
All right. Thank you, Gavin. I appreciate it.
Okay. I'm going to shut this down temporarily here. We will be posting the replay in a matter of moments, and we'll get back and take a look at some of these prepared comments from the banks. Obviously, banks in full focus between the Goldman Sachs Financial Services Conference and that Capitol hearing going on tomorrow.